Every time we learn even the smallest eye-opening fact about finance, our brain somehow encourages us to consider investing. And that's good. Nevertheless, before you start your financial voyage, you must consider the kind of investor you want to be. Do you desire to be a capable investor? Alternatively, you might just want a piece of the investment action. If the former describes you, then watch this video till the end. We'll be sharing some of the do's and don'ts that a wise investor lives by with you. In addition to his student Warren Buffett, Benjamin Graham is arguably the most skilled investor of our time. We'll be borrowing many of his ideas and strategies. Following that, let's have a look at some qualities that every wise investor possesses. 1. They never trust the market. It is highly recommended treating the stock market akin to understanding a person. Appreciate its allure, like admiring a woman's beauty, yet remain wary of its unpredictable nature. Many of its fluctuations are temporary, merely amplifying the circumstances. If you seek a lasting and committed relationship with your investments, it's crucial to overlook momentary volatility. The stock market often mirrors this behavior, where stock prices might soar to irrational heights, but occasionally, they'll also nosedive to obvious lows. You may be pondering the mechanism behind this phenomenon. As previously noted, the market is susceptible to sudden mood shifts and can unexpectedly surge or plummet. This clarifies why the stock prices of a much-hyped device soar for months, only to crash upon its release due to unmet expectations. Wise investors don't often linger in attempting to forecast market movements. Instead, they rely on diligently researched data. Thus, conduct a self-assessment to identify your tendencies and then cultivate discipline to steer clear of detrimental investing behaviors. 2. They put all their investment eggs in one basket. Warren Buffett's view on diversification suggests it's a defense against ignorance, indicating it's unnecessary if you're well informed about your investments. His advice likely aims to steer you away from blindly following the banking industry's recommendation to spread investments widely. The main reason behind this perspective is that diversification doesn't consistently limit losses. Rather than shielding your investments, it's more probable to hinder your growth potential. Realistically, comprehending every facet of 100 companies is not possible. It's impractical to dedicate sufficient time and effort to thoroughly research all these businesses for informed investment decisions. Opting for no more than 5 investments is preferable, enabling you to focus on mastering each one thoroughly. Remember, excessive diversification often signifies average performance. A prudent investor seeks to distance themselves from such mediocrity. Hence, it's advisable to refrain from spreading your resources across numerous investments. 3. They set an investment formula and stick to it. In the realm of investing, your emotions pose the greatest threat. Hence, it's crucial to proactively create a separation between your emotions and your investment decisions. This might entail devising a stringent formula that guides your every investment move. For followers of Graham's teachings, investment adheres to a formulated approach. Dollar cost averaging, a familiar concept to many, implies establishing a specific budget crucial for successful investing. Set a fixed amount of money to invest either monthly or quarterly consistently. This designated sum is intended for purchasing more of the previously chosen stock, regardless of its current price, a strategy known to incur consistent costs. Despite the emotional strain it may bring, this practice is a necessary step towards becoming a knowledgeable investor. Additionally, it serves as a robust shield against potential losses stemming from significant, one-time investments. 4. They apply Graham's 3 principles to investing. One of the best traits an intelligent investor can hold is practicing these principles from the guru himself, Graham. Before you invest in a company, always go deeper into your research. Analyze company principles and their performance for at most the last decade before you decide to invest in it. Diversify your investments to shield yourself from the losses that come with the monotony of your investment. Choose investments that offer slow and steady returns instead of those that promise insane profits. By assuring thorough investment study into everything, these ideas are simple to understand and put into practice. Pay attention to the difference between a company's current prices and any potential future value. Choose 3 or 4 of these businesses to concentrate on. Because you didn't keep all of your investment eggs in one location, you'll be able to save a good chunk of them, which will help you prevent losses if things don't work out. Through a 10 or 15% yearly return, you can continue to reap the rewards of your labor, which is typically the absolute minimum, but over time, these little profits build up. 5. They aim at capital preservation above all else. Making sure they expose themselves to as little losses as possible is a wise investor's key agenda and purpose. All of this ought to be accomplished without putting at risk or restricting prospective capital gains. Therefore, wise investors are concerned about protecting their investment cash. They would prefer to balance their losses and gains, keeping their initial investment intact. One may argue that this amounts to the construction of a safety net of sorts for them. The phrase margin of safety is used increasingly frequently. This indicates that these investors will make nearly risk-free investments. Every investor's primary goal should be to limit their losses. A wise investor would never compare their results to those of the market or the state of the economy. No, they make an effort to get a genuine positive return every year, regardless of the situation. They don't care if doing so results in lagging market indices. How would you recognize a wise investor in this scenario? They will always invest in assets with a high safety margin in order to protect the investment funds. If capital growth results from this strategy, they will only view it as a success for their techniques. 6. They ignore market fads. There have been several rumors regarding a big-name investment spread over the years. A good example of those that are essential in our community is cryptocurrency. Do you recall how people make predictions about this topic, claiming that paper money would eventually disappear? There is absolutely no substance to this debate, which lacks foundation to begin with. Consider yourself an astute investor who understands that anything can happen in the future. Be prepared for whatever is coming because it will happen. There won't be any red warning lights yelling at you to slow down because there is danger up ahead. Always stay focused by continually educating yourself on these crazes. Due to this, you'll be informed of what is occurring and its purpose. Additionally, you'll be better able to predict the outcomes. 7. They let opportunities pass them. Do you ever wonder why the most successful investors don't sell their stock just because the price suddenly tripled? The majority of people would probably be frantically rushing from their broker to their bank to make as much money as they could. Because of this, the majority of people are far from the elite investors. These select few possess the quality of patience, which causes them to let opportunities go by. They realize that in order to generate a solid return, it is not required to seize every chance that comes your way. They are intelligent beings who won't pursue every mouse that darts across the floor. Instead, they'll conserve their strength and patiently wait for a chance they can boldly seize. If prices start to decline suddenly, this advice will help you avoid losing money. You cannot do this if you are emotionally fragile. Before you can effectively manage your emotions, you need to practice and realize that it will take time. 8. They take advantage of the falling price. You need to be able to think quickly and remain calm before making decisions if you want to be a successful investor. This distinguishes wise investors from all other types of investors, because they maintain their composure despite falling market indexes. The rest of us react in a panic at even the smallest discomfort, leading to hasty decisions that will ultimately cost us. Money can still be made, which is fortunate, even if your point of view differs from everyone else's. Realizing your investment's value, even in difficult situations, is the only way to maintain your investment safe. If your decision to make that investment was justified, it makes little difference if the price is decreasing because you are confident that things will come out well. Even better, you are confident that your decision is supported by extensive study. In these uncertain times, have courage because no one can ever time the market perfectly. And that's one of investing's appeals. 9. They follow either of these 2 portfolio policies. Even after deciding which investments to make, a savvy investor continues to do their homework. The largest effort will then be choosing and keeping an eye on a certain investment mix. Another chooses a long-term investment portfolio that can operate automatically. Make sure that the portfolio you choose fits your needs, by taking into account your lifestyle and any family demands you may have. Sadly, the video has come to an end. But before I conclude, I want to give you a strong recommendation for Benjamin Graham's book, The Intelligent Investor. If you have read the book, please share your thought.